So lovely that you could join us. I wanted to, my name is Naseem Jamal, and I'm the Associate Director here at Parkinson Canada. Welcome everyone to this month's webinar on maximizing your impact, tax-efficient ways of donating. Before we begin, there are a few items that I'd like to go over. First, a land acknowledgement. From coast to coast, we acknowledge the ancestral and unceded territories of Inuit, Métis, and First Nations people. Also, for you to access closed captioning, please click on the CC captions on your screen and then click on Show Subtitle. If you'd like to submit a question for our presenters, be sure to write in the Q&A window. The chat window is there for you to say hello, and I see a lot of you have already started to do that, and talk amongst yourselves. Before we start, we are going to share a video message from Parkinson Canada's President and CEO, Dr. Karen Lee.
Over 100,000 Canadians live with Parkinson's. We have one of the highest rates in the world. My name is Karen Lee. I'm the CEO of Parkinson Canada. My late grandfather lived with Parkinson's disease, and I know very well the importance of family and how they have to come together to support one another, but most importantly, the person living with Parkinson's. That is why I am dedicated and committed to ensuring Parkinson Canada continues to empower those living with Parkinson's. Each year, our programs and services reach over 10,000 people. We are a community. We are here not only for the person living with Parkinson's, but their family, friends, and their care network to ensure we all continue to thrive. Our advocacy efforts are focused on raising the voices of people affected by Parkinson's. Our Parkinson Advisory Council is made up of people affected by Parkinson's from across the country. They bring a diverse background and experience, but most importantly, they provide me and the organization with advice on topics that are important to them and their community. As a scientist, I know the importance of investing in bold and novel ideas that lead to breakthrough discoveries. At the same time, bringing researchers, clinicians, and people living with Parkinson's to collaborate to push the needle in our understanding of Parkinson's disease. We invest in the next generation of researchers and clinicians to ensure that we continuously understand the Parkinson's disease and also the care management of people affected by Parkinson's. When I'm in the community, I want people to know that Parkinson Canada is with them in every step of their journey with Parkinson's disease. People often ask, when is the right time to connect with Parkinson Canada? Is it when they have their first diagnosis? Is it when their symptoms get worse? Or is it when they need more information and resources? The answer is now. Researchers and clinicians are working tirelessly to find a cure. Meanwhile, every single day, 25 more Canadians are diagnosed with Parkinson's. Our goal is to empower people affected by Parkinson's to live well now.
Okay, let's get started. I am absolutely thrilled to introduce to you our power panel of financial experts. Ellie Rubach is the founder of Rubach Wealth. Elke stands out for her unwavering commitment to addressing critical issues in financial planning and wealth strategy, a passion ignited by her own personal experience. Joining her is Ali Spinner, a partner at Crowe Soberman's Tax Group. She's been known for the last 20 years of expertise in public accounting, estate planning, and her exceptional contributions to the community. Together, they bring a wealth of knowledge and a dedication to help clients navigate complex financial landscapes. Welcome, Elke and Ali. I will pass it on to Elke right now to kick off our exciting session.
Thank you, Naseem, and everyone for having us here. My name is Elke Rubach, and I am over the moon, honored and excited to be presenting here with Ali. I'm a founder at Rubach Wealth. We do holistic family advisory, and among many things we do, we help families figure out their giving capacity and do it with confidence. But today it's about Ali, a phenomenal human being and a friend. Ali is a partner at Crowe Soberman's tax group and a member of the firm's management committee. She's a leader of the high net worth tax practice and works closely with her clients to ensure that their short and long-term personal, financial, estate, and philanthropic goals are carefully considered in their planning. Ali brings a high level of passion and warmth to her practice and enjoys building deep relationships with her clients across generations. Ali has more than 20 years of experience in public accounting and estate planning. So please welcome Ali, and thanks for being here.
Thank you so much, Elke. Okay. So I'm going to launch right into it if that's okay with you. Excellent. And I look forward to answering any questions that come through. I know that we're going to leave time at the end for those questions, but I'm going to jump right into it.
Perfect.
So it is a pleasure to be here today. Thank you for that warm introduction. I am an accountant, and I am very passionate about helping taxpayers and donors, much like yourselves who are all on this call, make very tax efficient gifts and lead their most tax efficient life. So when I talk about philanthropy, I generally talk about the way that I think about it is I think that there's 4 W's of philanthropy. So the most important one, which I'm actually going to talk about the least, but the most important one is the who. Who are you giving money to? We're all here in support of Parkinson's, so we know who the who is. And I'm not going to spend much time talking about Parkinson's. I'm here to talk about, exciting tax ideas and things like that. But certainly the who, I like to start with that, because if I don't, everyone's like, well, what about the who? I'm like, no, of course. So I'm going to move on from the who. But now I'm going to talk about the what. What is it that we can give? And it's important when we think about all of the different things that we can give. We think broadly, because there are different things that we can give. Of course, we can make gifts of cash to charities. Absolutely, we can give gifts of cash. You can make gifts on credit cards for sure. And of course, when we make a gift, we receive a donation receipt. And generally, if you give more than $200 a year in total to philanthropy in Canada, once you're over the $200, you receive a tax credit, about 50 cents on the dollar. So for every dollar we're giving away, it really only costs us about 50 cents out of pocket. So number 1, we can give cash. Number 2, something else that's really important and very, very tax efficient that we can give if we have the opportunity to, is to give away shares of appreciated stock. Now, I love talking about this. I think that sometimes people think it's more complicated than it has to be. It's not complicated at all. It's as simple as, communicating with your broker that you want to make a donation of stock to Parkinson's. It's as simple as having the broker complete the share transfer form. We can talk more about that after. But the reason that the donation of appreciated stock is so important is that when you donate shares of a public company, and it's either if you donate it yourself personally or if you don't make the donation through a corporation, when that donation happens, the gain that's embedded within the stock, you don't have to pay any tax on, and you still get a full donation receipt for the full value of the amount of the stock that you've given away. So for example, if you bought a stock for $1, it's now grown to $10. If you were otherwise going to sell the stock, you would have a $9 gain, whether it's yourself personally or in a corporation. But instead of having to pay tax on that gain, if you simply make a gift of the $10 of stock to an organization like Parkinson's, the beauty is that you never have to pay tax on the $9 of gain within the stock, and you still get a donation receipt for $10, which means you can use that $10 receipt against all other sources of income. Further as well, there's also a triple benefit that if you have a donation of appreciated stock within a corporation, so if you happen to have a private corporation, whether it's an active operating business or if it's an investment holdco, in addition, the triple benefit is that you also get an addition to the company's capital dividend account for the full amount of the gain. So normally, well, I'm not going to get into all the tax theory behind that, but the beauty is that it's a triple benefit, which effectively allows the shareholder of the corporation to access tax-free dollars as well from their company, in addition to the money that you're giving away. So we talked about cash, we talked about the donation of public company stock. That's a super efficient way to give money, quite simple. Something else that people can give away in terms of the what can we donate. Sometimes people decide to make donations of their RSP or their RIF. RSPs and RIFs are very important in the Canadian landscape to help us save for retirement. And sometimes people are fortunate when they get to retirement age. Either they realize, oh my goodness, once you turn 71 years old, you're forced to start withdrawing money out of your RSP when it converts to a RIF. Some people say, you know what, I'm going to choose, rather than having to take this taxable amount into my hands, I'm going to take that RIF withdrawal and I'm going to direct it directly to charity so that I can end up with a corresponding offsetting tax deduction, which effectively has the result of not having to pay tax on that RIF withdrawal. So if that's a position that you may find yourself in, by all means, that's a nice way of being able to efficiently manage, from a tax perspective, the receipt of money coming out of a RIF. As well, some people choose that they may need their RIF money to live on during their lifetime. As we may know, when we pass away, unless we leave assets to our spouses, if we leave assets to anybody else, there is full tax on registered accounts, on RIFs and RSPs. So for example, if you have $100,000 in your RIF at the time of death, then that money would come into income. It gets taxed at your highest tax rate. Generally in that year, your tax rate gets pushed up into the highest rate. So often people use that, because that is the most taxable asset that you can have at that time. Some people choose to say, well, because it's taxed at such a high rate, I'm going to donate that piece to charity so that Parkinson's can benefit from it, and you don't end up having this huge tax event otherwise. So that's something to consider as well. A little bit more we're kind of starting off from the most simple and we're moving along the journey to more and more complicated, but something to consider also is giving away an item like a private company share. If you happen to be a person who has a corporation, a private corporation, you don't just have to give away public, or you're not limited to only giving away public company stock. You can also give away private company shares. It's a little bit more involved, not quite as simple, but it can certainly be very meaningful to do so, and still quite tax efficient. It's not as quite tax efficient as it can be to the donor versus giving away the public company stock, because you don't end up with the tax-free gain. If there is a gain embedded within the private company share, you still have to pay tax on that. At least you're only paying tax on it as a capital gain. Something else that actually comes up quite a bit, and Elke, I know that you and I have discussed this many times, is a concept of giving away a life insurance policy. What I find with my clientele is that many people obtain life insurance at different stages of their lives, and they obtain life insurance because they believe that they're going to have a need for this insurance when they pass away. Sometimes that need is to fund tax on death. Sometimes that need is to leave a legacy to family members, whatever it may be. But there are people as well who end up with life insurance policies who realize that, you know what, I thought I was going to need that to fund this liability, but that liability isn't there anymore. And sometimes what people do is that it's possible that, and there's a whole bunch of permutations and combinations to think about this, but a couple examples could be is that if you have a paid up policy, it's possible to make a gift of that policy to an organization, and the policy then gets valued in today's dollars, And based on the value of that policy going to the organization, you can receive a charitable donation today, get some tax benefits today. It's true that the organization won't receive the payout of the policy until a future point in time, but you're still able to get, potentially a significant amount of tax benefit today. Some people choose to have life insurance policies that are designated that only pay out when the life insurance pays out. That's possible as well. In that case, the donation, the tax benefits of it will be coming to fruition when the life insurance pays out. And some people like myself, for example, I have one gift that I make an annual gift to a particular charity, and I've decided to endow that gift. And what that means is that I have taken out a life insurance policy now that funds an amount of money that ultimately the policy is owned by the charitable organization, but I fund it. So when I pay the policy premiums, I'm receiving a tax donation today, and the organization eventually will receive this endowment fund effectively that can then perpetuate my gift. Didn't want to get too far down the rabbit hole here technically in life insurance, but it's certainly something that people can use to fund various gifts. And then there really is no end to things that can be donated. Whether it's cryptocurrency, NFTs. I mean, I'm starting to get, it's the more nuanced and interesting or funky that we get in the things that we're donating, it's not as necessarily easy for the charity to accept, but they will figure out a way to accept it, of course, if there's value there. But again, so just to recap, when we think about the different things that we can donate, cash is obviously very simple, but something that I want you to take in mind is that if you're a person and you find that if you have non-registered investments, so not a TFSA, not an RSP, not a RIF, I'm talking about investments that are outside of a registered account, whether in your personal name or in a corporation, it's extremely tax efficient to donate shares of appreciated public companies to an organization like Parkinson's. It's very tax efficient. It's true. Some of you might know that there's some changes coming in the world of alternative minimum tax. That is a whole very complicated area that I'm happy to talk about another day, but for this purpose, I'm gonna leave it at that. And it's still in the world of alternative minimum tax. It'll still be very efficient to donate public company shares. Okay, so that's my W of what we can donate. I'm now going to move on to where we donate. And when I say where we donate, often what first comes to mind is, oh, I'm an individual, I should make an individual donation. And individual donations are great. The important point, though, is that depending on what our personal financial structure looks like, it doesn't mean that the only place that we can make a donation is from our personal account. So it's important to take a step back, look at your financial picture, and decide, does it make the most, where am I going to get the biggest tax bang for my buck? Where can I be most efficient as possible? Because when we can be more efficient, we all win. We all win, we can, and in fact, we might have more money that we can in fact turn and leave to charity as well. But when I talk about that, it's important to remember that we still can make donations from corporations. And you can make a donation from an active operating business. You can make a donation from a passive investment business. It doesn't have to be active. You can make donations as an individual. You can make donations from trusts. There's various ways. We talked as well about directing money directly from registered accounts directly to charities as well. So it's important to recognize that you don't simply have to write a check or do something personally. You absolutely can look at your structure. And I'm keeping it fairly straightforward. Obviously, the more complicated structures that people have, the more I would say time has to be involved in determining where the gift should be made. But don't just assume that the most effective way to make the gift is from yourself individually. It's important as donors that we talk to our advisors and take a step back and say, okay, well, wait a minute. Is there a better way to make this gift in my structure versus just making it personally? In many cases, it will make the most sense to make the gift personally, and that's totally fine. Something else, and I actually was just discussing this with a colleague of mine in the office last week, is that even if you give a gift, for example, from a corporation, and it's true that the corporation is the one that's going to receive the tax receipt, the donation receipt, but the recognition of who's receiving the recognition for that gift can be in your own personal name. The government's position, the CRA's position, is that there is no benefit associated with having the recognition in your personal name. So not to worry that if you've got an investment holdco and you're going to make the gift at that level, yes, that's the company that's going to get the receipt. You can still have any recognition in the name of your own name, which is beautiful. Okay, so now I'm going to move on into my third W, which is the when. So we talked about the what can we give, we talked about the where can we give it from, and now we're going to talk about the when. And when I talk about the when is so important, and it really comes down to timing. And it's a question of, are we going to give away money now? Are we going to give away money in the future? Why does it matter? Why do we care? So from the perspective of the charity, I'm sure that the charity would certainly rather have the money up front, in the sense that, you know, they need the money to fund all the wonderful things that they do. And it's very important. That being said, I'm sure that they are also, hopefully I'm not speaking out of turn here, I'm sure that they're also very, very grateful to receive gifts that come at a later point in time. So I'm not really speaking to it from the charity's perspective per se, but really from the donor's perspective. The reason why the when is so important is that as a tax planner, in order to make sure that our gifts are as tax efficient as possible, I like to make sure that I'm marrying up the timing of when we make the gift to the timing of when we need the tax break. And what I mean by that is I've had some situations of new clients who come to me and say, oh, Ali, I'm going to come and be your new client. I sold my business 3 years ago. I had a huge tax bill 3 years ago. I'm ready now to make some big donations. I want to make some big pledges. I want to make some big donations. And I'm saying, okay, this is great, but I really wish you would have come to see me 3 years ago, or I really wish that your advisor who you were working with would have figured this out 3 years ago, only because it's possible that your income post liquidity event, or, you know, post sale, or whatever it may be, perhaps your income isn't as high as it otherwise was in the year of the sale. And it might take you longer to realize the tax benefits of making that donation. So when I talk about the when, again, as I'm always looking through things with my tax lens on, I always like to make sure that I'm marrying up the, you know, how quickly can we get the tax benefits from the donation with respect to when is our tax going to hit. So that's very important. So certainly, if you have a year in which for some reason there's, you know, maybe you have a sale of a specific asset, or maybe you've sold a stock that's done exceedingly well, or you remembered and you donated the stock before you sold it, but that's okay. Certainly at those times, that's a great time to fulfill pledges that you may have made and are still outstanding, or perhaps to make larger donations to get the biggest bang for your donation dollar, if you will. When I say biggest bang, I mean obviously the largest reduction in tax. I just want to touch on very quickly something that is important to people as well, is that if you are a person who's going to have a very large tax event in a given year, and you might say, well, I am going to have this very large tax event, and I know I want to be philanthropic, but I just haven't decided yet how much I want to give to each organization. What you can explore is something called a donor advised fund. I'm just going to go into this quickly. So a donor advised fund is very similar to a private foundation. I myself started a donor advised fund for $5,000 back at the time. I call it my baby fund. But I just want to get you comfortable with the terminology, the benefit of it. And many different financial institutions have a donor advised fund. There's also community foundations that have them. You're effectively able to give money away today, put it into a charitable program vehicle. You are giving up the right to earn the investment income from whatever it is that you're putting into the fund, but you can decide at a later point in time as to where you're going to give the money. So the beauty is that you can upfront your donation receipt today. You can time the timing of the tax benefits from the donation receipt to your liquidity event, but you don't have to decide until a future point in time where the money is actually going to go. So I just wanted to put that thought out there as well. And so we've talked a lot about giving away, making donations and giving away assets today, which is, again, it's great. These, organizations need money to keep the lights on and do all the good work that they do for sure. But something else that's very important in the concept of donation planning and estate planning is the concept of giving away, making gifts at the time of death. And the reason why I want to bring that up, or gift through will, I should say, the reason why I want to say that is that the way that our tax system works in Canada is that we're allowed to own assets that grow and grow and grow in value, and we only pay tax on that growth at the earlier of 3 days. So one is if we otherwise sell the asset. So if you decide, you got a position in something and you want to sell it, fine. Number two is if we leave the country, subject to certain exceptions. If you leave the country on the way out the door, Canada wants to make sure that they get their clause and their tax dollars on your way out. And then the third one is when we pass away. Now, I mentioned that if we leave assets to our spouse, there's usually not tax. There's the ability not to have tax at the time of death of the first spouse. But at the death of the second spouse, when we're passing assets down to children, or if the first spouse is passing assets to children, there can be tax. And at that point in time, there is a realization of all of the gains and all of our assets. Our registered accounts come into income fully. If we have any non-registered investment accounts, all of the gains within those accounts are realized all at the same time. And what many people do is they realize that at that future point in time, there is going to be a large tax liability, or larger than normal. And what they do is they also realize that might be the time in which they want to make a substantial gift to an organization like Parkinson's, to leave a legacy to the organization. But the benefit also is that you're able to match up the timing of the tax receipt by giving away that asset through your will. You're able to match the timing of the tax receipts so that you can use the benefit against the tax that otherwise is going to be triggered at that time when assets are being left, or when at the time of death. And that's often where people, when they decide, well, how much should I give away now? How much should I give away later? It's important to take a step back, look at your assets holistically. And of course, this is only if you're, I shouldn't say only, but I'm presuming that you're looking to make tax efficient gifts. By all means, we don't have to always have our tax lens on. I want to make sure that I say that as well. It's important to fund organizations, and many people fund charitable giving, and great, they get tax benefits, but that's not their main driver of giving, which is wonderful as well. But if tax is a factor in your wealth planning and estate planning, then it's important to also consider, okay, when and where, in terms of timing, should the gifts be given? So those are the kind of the three big pictures. And I'm going to turn it over to Elke to start asking questions. But so just in summary again, it's what we're giving away. If I leave you with one golden nugget, the most efficient way to give the most efficient item to give away is appreciated stock. Don't forget it. If you find that you're writing checks for, $1,000 plus and you have the ability to give away public company shares, go for the public company shares. The second one is looking at your overall portfolio. Where should you be giving away? Does it make sense to give from a registered account, from a regular account, from a corporation, or not? And then the last one is the timing. Does it make sense to give away something now? Did you want to give away something in the future? But matching up the timing to be as efficient as possible.
Ali, that's spectacular. Thank you so much. There's so much information, and I'm sure the audience must be like, oh my God, this is a lot of information. Where do I start? Honestly, I think start from the beginning. Have the conversation. Have the first conversation with yourself. Is this something that, it's not that you have to do it, is this something I'm curious about? And then reach out to your advisory team, be it your accountant, be it your financial advisor, and then map it out and really do an idea, have an idea list, an idea dump, and figure out why not, what scares you, what drives you, why is it? And then honestly, it's starting with a financial plan that will, and if you could do it yourself, you would have done it already. So work with your advisors, because it's an objective opinion, and numbers don't lie, and that can tell you how much money you need so you can give with confidence.
Yep.
And then from there, say, okay, I have more than I need. I'm never going to be financially dependent on anyone. Great. So with this money, Do I want to see it in action when I'm alive? Do I want to see it when I pass? Do I want to do something for my children, my grandchildren? Everything is possible with the right guidance, disciplined guidance, and honest conversations, first with yourself, then with your advisors, and working as a team. It does take a village. So,
Elke, I just wanted to, before you jump into a question, I just wanted
Yeah.
to add something to what you're saying, because I think it is so important as well. What I also think is so important about philanthropy is that it's a beautiful tool for families to have financial discussions with each other. I spend a lot of my time, I'm sure you do as well, talking to our clients about having financial discussions with our children, whether it's, how much information do we tell them? Do we not tell them? How do we help them become, financially literate, become stewards of wealth? I find that starting with the discussion around philanthropy is a beautiful way for donors to not only educate kids on financial topics, but also it gives them an opportunity to share their goals and objectives and family values with their children. And I think that that's very important. And sometimes that trumps other items in the discussion. But I think what is so key and important in having a family discussion of, okay, we have this much money to give away. These are the reasons why we support Parkinson's. These are the reasons why we support these charities. These are what our values are. These are what our goals are. I think it can be a beautiful tool to have those discussions. So I just wanted to share that as well.
Absolutely. And the other thing too is when we do plans with families, I think the one thing that is a constant is we're looking for harmony in the family. You want the family to come back and stick together.
Yes.
So it's rarely about money, because there's this misconception that everybody thinks that you have to be a Rockefeller or a Lee Ka-ching or any of those guys to be a philanthropist. Not really. It's, what do we stand for? What are we proud of? Which values do we want to be the flagship of this family going forward into next generation and so on? There's zero financial literacy in the education system. And when families go from short sleeves to short sleeves in 3 generations, it's because nobody was taught about financial literacy, because nobody was taught to teach about financial literacy. And philanthropy is a beautiful tool, because you're not talking about what Johnny's getting or Sandy's not getting and so on. It's what's important to us. What do we stand for? And then you figure out the how. And is it the time now? And then maybe today it's, something as health related, and tomorrow there's something that is education related. And then sometimes, somebody wants to go into science. So it has to be flexible and has to follow the family, but it really brings and keeps families together. So that's absolutely essential for you guys to know. So let's jump into the questions, because they are coming fast. So send more, please, because the more you ask, the better it is. And if for any reason we don't get to answer all of them, we can get back to you later on. Or if we don't have the answer, we'll figure it out too. So Ali, I'm interested in donating shares in the future. How do I prepare that now?
Okay, so if you're interested in donating shares now or in the future, so it truly should be as simple as obtaining so Parkinson's will have a share transfer form, and really it's information where you provide your broker with Parkinson's brokerage account information. It's as simple as that. And then once the broker has the instructions from you, they can have the shares transferred out of your account into Parkinson's account. That's it. That's all you have to do. And whether you're giving it away now or in the future, that's really a question of when you're ready to make the donation. Otherwise, I don't think that there's necessarily anything that you would have to do to plan for it.
Great. Is it better to state donations in the will, leave it to somebody to a person with a requirement that they must donate a portion, for example, 10%, and will they get the tax benefit?
Okay, that's a great question. So I think what the question here is that somebody wants to know that they decided that they want to make a gift through their will, and what the mechanism or the alternatives are to do it. So if you want the tax receipt to be in the name of your estate, which is, I think, generally what people want, it's very important to make sure that that is a gift made by will. So it's not a situation where you say, I leave X dollars to X person, and then X person, please take this money and give it away. You are leaving the money directly to a charity, or sometimes you're leaving it up to the executors to decide who the money is going to, but you're not specifically giving a gift to your favorite niece or nephew with the expectation that they give it away. Because if that happens, what will happen is that it's the niece or nephew who will get the donation receipt, as opposed to your estate getting the donation receipt. And if you're doing this for purposes of minimizing tax at the time of death, then we need the receipt to be in the name of you, in the name of your estate. So that's important. Now, something else that was mentioned there is they said, you know, I heard the percentage terms, and it can work both ways. Some people choose to give a set amount in their, some people choose to give a set amount in their will. Some people choose to give a percentage in their will. They both can work. The percentage can be a little bit more confusing because there's got to be more calculations that have to get done. But they absolutely both can work. And I would say there as well, what's really important is that if you're interested in making a gift by will, you have to talk to your will professional. I'm not a lawyer. Elke, you're not a lawyer. I'm an accountant. I can get you this far, but you really have to make sure that your legal documentation is up and running, and so that your will lawyer can draft this and make sure that it's appropriately in your will. So although I'm saying this to you now, take it with a grain of salt, speak to your lawyer for sure, but it's not terribly complicated.
And if I may add something, make sure it's a wills and estate lawyer, because many times I see people that go to the real estate lawyer because they bought a condo and they bought a house and they bought this and that, and they get their will done for free. There are a bunch of intricacies that go into drafting a will that you need to pay attention. And remember, a will is a living document in a way. It's not that you do it once and it's done and forever. You can change it in the future. I mean, with certain limitations and restrictions, but you can change it. You can change your beneficiaries. You can change a lot of things, but make sure you don't have just your will and forget about it. And if your will has not been looked at in the last 2 or 3 years, do yourself a favor and take a look. Probably some things have changed.
And it's, yeah, I like that. You go to the real estate lawyer for the real estate advice. You go to the wills lawyer for the will, for sure.
Correct. Yeah. When I was practicing and I was in corporate law, people would say, so what about criminal? I have no idea. Like, they assume that because you did law, you're everythingist. So no. Okay, next question. Are tax credits different in each province, Manitoba compared to Ontario?
Absolutely, they are. So 100%. So there are slight nuances and differences with respect to the credit benefits in each province. So in Ontario, it's 50 cents in the dollar. I'm sorry, I don't have the various different provinces up the tips of my fingers. It's generally very, very similar. It shouldn't be all that different. There might be slight nuances between the provinces, but it's generally pretty close to 50 cents on the dollar. But you are absolutely right. In our tax system, there's the federal piece, which is the same across the country, and then there's provincial specific. And if anybody needs to reach out afterwards, I'm happy to look up a specific province and give you that direct advice for sure.
Perfect. Thank you. So my husband and I did our wills many years ago. Would like to update. Now that we're retired, have grandchildren, and want to ensure when our estates settle in the future, we do some charitable giving and do that in the most beneficial way. What basics can you suggest?
Sure, that's a great question. So what basics can I suggest? So it's a great question. It's hard to give a basic answer, but I'll keep it as simple as I can. Generally, when I work on estate planning, I like to compute, okay, what is the ultimate amount of tax that's going to be paid in this estate when the time comes to pay the tax, based on appreciated gains, based on the amount that continue to be in registered accounts. And at that point, I start to look at, the different pots of where money can come from to fund donations. Certainly, some people, as I mentioned before, some people choose to make, a beneficiary designation in a registered account, where that registered account goes directly to charity. The reason being, again, that on death, money coming out of a registered account is the most taxable. It's the most taxable kind of money that you can have at the time of death. But the same objective can be achieved just by giving cash per se. That you can end up with the same tax result. You can also end up with preferential treatment again of donating, public company shares. That's still something to consider. Although it's very hard to crystal ball and say what you're going to own at the time of death. It's not necessarily, your portfolio might change, the way that your structures might change. What I see typically is that people, if they know that there are certain charities that they've looked after, that they've made donations to through their lifetime, they are sure in their wills to say, on the second to pass away of the spouses, I would like to leave X dollars to charity 1, X dollars to charity 2. That is certainly the most straightforward way to do it. And the wills and estates lawyer will look up and include the registered, like the charity number of the specific charity, so it's right in there and it's very, very obvious. That's likely the most basic way to do it, is just to make sure that it's in your will, and that you've perhaps had something this is, I'm going to go on a totally different angle for a second, but if you're in a married, if you're married and you decide, well, I don't want to leave anything to my spouse, I'm going to give it all to charity, that's something you can't necessarily do. Spouses have entitlements and things like that. Children, not so much. Maybe again, this is a discussion for another day, but I think also, just being open and discuss with family, when we pass away, we are intending on leaving these amounts to these different organizations. If the amounts are substantial, just so that people understand, really. Yeah.
So I guess it goes back to the importance of having a good relationship with your accountant, your lawyer, and your financial advisor to have a plan and figure it out, right?
Absolutely.
Next one. I am very surprised about your comment that when charitable donation over 200, one can receive a tax credit of 50 cents on the dollar. I thought the tax credit was only about 20% for a higher donation.
Nope. So I'm glad you asked the question. I'm very glad you asked the question. The tax credit, the maximum tax credit is 50 cents on the dollar. So when I think about it, when I'm making a donation, the way that I think about it is, well, if I'm writing a check for $1,000, it really only costs me out of pocket $500. Once it's great. I mean, I guess there also is the concept of, it depends on what tax. I'm assuming that you're not in the lowest tax bracket, because then you wouldn't be paying tax, I guess, to start with. But at the same time, depending on your tax bracket, and I'm sorry, I don't have the exact number at the tip of my tongue of where you'd have to get to be to the 50 cents on the dollar, but you get up there pretty quickly. And charitable donations are worth 50 cents on the dollar in terms of a tax credit. So they're very tax efficient, because if you think about it, it's a choice of, do you want to give the money, and I'm not here to make a political statement, but the choice is, do you want to give your tax dollars to the government, and the government can determine how to spend the money in society, or you can give the money directly to the charity, and as a result, the government basically gives you back the money that you've been, that you otherwise would have paid on those dollars. So it's you deciding effectively where your tax dollars are going directly to the organization that you want to.
Great. So can you tell me more about donating from a registered account? Expand on that, please.
Sure. So there's a couple of different things. One is as simple as, just making a withdrawal from the registered account, and whatever the amount is that you withdraw, you can send it directly to the charity. The point that I was making before, if it wasn't clear, was just that when when your RSP flips into your RIF, depending on what your financial situation was, you may be lucky enough to find yourself in a situation where it's excess, no different, for example, than CPP or OAS or any of these things kicking in. It might be excess cash flow that perhaps you just don't need. And if you find yourself in that position, the point was, well, you could consider taking that money. You're going to have to pay tax on the minimum RIF withdrawal anyway. You may as well, if you want, take that cash flow and send it to the charity, so that, yes, it's true, you're out the cash, but now you're not having to pay the tax on it that you were going to have to pay on cash you didn't need anyway. So that was one example. And then the other is that it's possible, and again, this is something you would have to speak to your lawyer about. It's possible to have or you can actually speak directly to the financial institution, a beneficiary designation inside of the registered account so that you can leave it directly to charity on your passing. Something else that's interesting, I actually just had 2 clients do this this past year, is they decided that they were quite wealthy and they decided they didn't need their registered accounts anymore. And they wanted to make a full donation. Both of them wanted to make a full donation of their registered account to charity. It was beautiful. One was worth about $1 million. One was worth about $400,000. Obviously, these were people of significant means who can do that. So the important point was that if you just go to your financial institution and say, oh, give me all the money, I want to send it to Parkinson's, what's going to happen is that the financial institution is obligated to withhold a certain amount of cash to fund the tax that otherwise would happen on the withdrawal, because they don't know that you're giving the money to charity and that you would have a corresponding tax credit to offset that tax. So what we did is, if you actually write to the government, I believe that the form is called a T1213, we wrote to the government and we said, okay, client 1, their RIF with this this financial institution is worth $1 million. They are planning on making a full donation of the RIF. We actually just this week got the letter back from the CRA saying, great, please give this letter to the financial institution. And it tells the financial institution that the government has approved that the financial institution doesn't have to withhold any money on that registered account, because the full amount that's going to be sucked out of the registered account is going to be going directly to charity. And we know that, and the government knows that the charitable donation, the receipt that they're going to get from that donation is going to completely offset the tax coming from the RIF withdrawal. So if you know that you're going to be making a significant, if you're going to direct a significant amount of funds while you're alive to charity from a registered account, you can certainly ask for reduced withholdings. You basically have to ask permission before you do it. Otherwise, if you just suck the money out of the registered account, you're going to be subject to withholding, and you'll have less money to send to charity, of course. Yep.
Great. So say in my will, I have that I'll make donations, but if I die first, can you talk to that?
Okay, so I think what this is saying is you want to make sure that the donations that you make only kick in on the second to die between spouses. So the key here is that the way for this to work is that you need spouses to have mirror wills. And this is a little bit confusing, and it's true, it may not work perfectly, because what can happen, it basically means that you need both wills to say, if I die first, give all the money to my spouse, and if I die second, give $100,000 to Parkinson's, and and give whatever money you want to give away to your final beneficiaries, if you will. And the challenge there is that your spouse might say, well, no, I don't want to give the money away, or I want to give away more, I want to give away less. So your choice is to either have it all go to your, like, if you want the spousal rollover, if you want your spouse to benefit from those assets while they're still alive, it's going to be more challenging to control that they fund that donation on death, unless you have like mirror wills effectively. Many people do have mirror wills where they both would say, they both read as, if I die, usually it says if my spouse survives me by 30 days, all my assets go to my spouse. And if my spouse is not alive, then give my money away as follows. And if you're both supporting the same charities, there's no issue, right? But then of course, you're also assuming that your spouse is not going to change their will after you go. I'll leave that for another day. Yeah.
Okay, perfect. So again, the importance of looking at your will and make sure that it's properly funded. And if you don't know that it's properly funded, a financial advisor, a lawyer, your accountant should be able to guide you through that one.
Sure.
Because we have seen wills where it's not properly funded, so nothing can happen. So you're like, okay, that's a problem.
Yeah.
So once it becomes a LIF, it's not possible to get the same benefit.
Okay, I'm not sure. So a LIF is a locked-in retirement account. It's possible. I'm not an expert on LIFs. It's possible that if there's a locked-in feature that you can't access Perhaps. I mean, I'd have to look at the specifics about the lift, but I assume what they're trying to say is that you're perhaps not able to take out excess money. I'm not sure, to be honest.
I'm thinking it must be a RIF that he was talking about.
Well, when you have a RIF, you
have to
when you have a
withdraw.
RIF, you can't, you must withdraw, and you can make excess withdrawals. You don't have, there's a minimum you must take out. I assume it's the same on the lift side. I'm not sure. But you know, generally there's a minimum you can take out, and then there's more that you can. I know there are some locked in plans where there's just more limitations on them. So fair enough. There could be some specifics on your specific plan that prevents you from achieving that.
Wonderful. So I think we have all the questions answered. And I'm going to thank you very much for everybody's time and attention and questions. I'm going to pass it back to Nasim, but thank you, Ali, so much. Always an absolute pleasure.
Pleasure to be here. Thank you for having me.
Thank you.
Thank you. Thanks for passing it back, Elke. Thank you to everyone for attending our webinar today, and thank you for asking such amazing questions. That was such a great conversation. I wanted to do a special thank you to you, Elke and Ali, for the conversation and the information that you gave today about really a lot of really different ways of giving to charity in tax efficient ways, and doing it in such a warm and easy, I thought, very easy to digest way. We were really awfully lucky to have benefited from your knowledge and expertise today. Thank you so much. To all the attendees today, thank you for attending. Also, please keep an eye in your email box around November 21st for a special giving opportunity for Giving Tuesday. There has been a very generous donor who has provided us $45,000 in matching funds. So for any gifts that are given between November 21st and December 31st, all of those gifts will be matched while the funds last. Today's webinar attendees will receive a follow-up email and a link to the recording of this webinar in case there were some things that you may have missed, and any resources and links will also be included in that email. I also wanted to invite everyone to join us for our second webinar in November. It's next week, November 15th, and the webinar is called The 6 W's of Clinical Trials and the Canadian Pipeline. It takes place November 15th from 2 to 3 p.m. Eastern Standard Time. Watch for your email boxes for details and a registration link. I think that is it. On behalf of all of us here at Parkinson Canada, I'd like to say thank you for joining us today, and I hope you have a fantastic rest of your day. Thanks so much, and look forward to seeing you again.